back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have Michael Oliver with me again. We missed Michael last week. Sometimes the schedule is so full it's hard to squeeze him in, but we like to have him here as often as possible. In fact, he is the most frequent guest we've had over the years because his message is so important. I found it to be so accurate. So welcome, Michael, for coming on my show again. I'm glad to have you with me.
I'm always glad to be back, Jay.
Always good to have you. You know, I couldn't say that if you were telling me stuff that wasn't working, but it's working.
Right.
I mean, you're a nice guy, so even if you were screwing up in your recommendations, I would still like to talk to you and have you around. But the fact is, everything I've seen you do so far has been really very accurate. So I want to ask you a little bit about, you know, this sort of big picture that you talked about last year. You talked about some major tectonic shifts. We've had these bull markets in debt. My goodness, the bull market in U.S. Treasuries goes back to about 1982 or something like that. And, of course, we've had this equity market since 2008, 2009 that's been on a tear. And you talked about this major tectonic shifts in the markets where those that were in bull markets will head south, and those that were heading south already are likely to turn positive, and certainly you know, the precious metals markets have started that out. The commodity markets you've predicted would also rise as well at some point here. Where do we stand? Just go over that with us, perhaps for the benefit of those that might not have heard you last year, Michael. The major tectonic shifts. Talk about that.
The asset classes move. Money moves everything, and central banks provide the money. Okay, that's the grease in the wheel. Okay, or
sure.
Viewed as the water level in the swimming pool. It's always rising, okay? Sometimes where they want the money to go, it goes there, and sometimes it doesn't. And sometimes it goes where they want it to go, but later it changes trend. It's like a river that, you know, it changes its route. Investors are the key in that. And it was my view that commodities first off, commodities had beat stocks handily from 2000 through 2011. Mm-hmm. You didn't make any money in the stock market for that period of time on the S&P, for example, whereas commodities went up drastically. Gold went from $300 to $1,900, you know. Then commodities peaked in 2011. It was pretty clear at the time in our reports. They topped in relative performance and in net trend. They all went down in varying stages. Oil was sort of the last one to really give it up and got all the headlines, and most people weren't aware of the commodity collapse till then. Well, you can only take commodities so low. And I don't care what the arguments are about how supply-demand is no good and we're in a worldwide recession or whatever the argument may be, commodities will not go to zero. And after they've had enough due time and down on the downside and have given off the technical evidence of a bottom, then expect a bottom. And we could see that last year clearly shaping up with gold in the leadership role, silver neck and neck with it, and also the gold miners. And sure enough, those three broke out early in the year, completed by early February. And in April, the lagging commodities such as oil, cotton, corn, soybeans joined in. And some of them really had to make a race of it in the latter part of April to achieve the breakout levels that I needed to see on quarterly momentum. But that shift is underway now. I think you've got the oversold commodity markets, some of which are now genuine bull markets like gold, some of which are going to have major bear market rallies. That what I would count as oil, which I think is going to about 60 by the end of this year. And that up move in commodities will attract the attention of investors. Already some have made the move out of unstable sideways stocks, which is really an optimistic definition. Because if you look at the European markets, they're not sideways. Mm-hmm. In Japan, it is not sideways. It's only the S&P 100, and the Dow that are sideways for the last 2 years. But that makes investors nervous on the one hand, that which has been rewarding them for a long time, and they're starting to move some of that money out into commodities, which can be perceived as a value play. Mm-hmm. So all the money's out there. Central banks have offered it, provided it amply, but it's changing its route. And I think that one of the key factors also is the debt market. And I'm speaking not of the high-yield debt, which has already suffered a lot, but the so-called safe debt sector. That'd be government bonds, the U.S., German, and Japanese, which yield very little. That trend looks in jeopardy. The uptrend in price, the downtrend in yield. That looks like it's going to turn this year. The only question in my mind is whether that turns After the S&P has another major leg down, because the S&P going down would entice some buyers to buy safety, quote unquote,
Sure.
and therefore keep the bonds afloat, or whether the bonds are actually going to break first, yields are going up, and that's going to drag the S&P down. And that's the one question mark I have. But I do think that we're going to see a top in prices in bonds this year and a much deeper decline in the stock market.
Well, it certainly seems to me to be all about confidence, Michael. You know, as long as people are confident in the dollar, confident in the United States and its the dollar hegemony, I should say, that in fact, you know, whenever the equity markets go down, as you say, money flows back into the bond markets. But what happens if there is a loss of confidence in the dollar itself and in the the elections or whatever might trigger a loss of confidence, and then you could see that happen, I guess, and who knows, I guess. But you can't really tell, I guess, at this point in time, which is going to come first from your momentum work. It's up in the air at this stage.
Well, they're both. Well, the S&P is already, as far as I'm concerned, it's a broken beast. It's a dead man walking. It's going down. It's just fooling around right now. This has been a bear market rally. It is not a surge to some new highs or anything of that sort. It's just caught in congestion, sharp down, then a sharp back up. But it is a top. The question is whether it goes down in the next month or two, which I expect, and bonds are with it, and whether a weak bond market helps precipitate. And I see the rising commodity market could rattle the bond market, see?
Yes.
That's the issue. Because I see the commodity rise is not a tepid one. I see double-digit % gains in most commodities. In oil, we're talking, I think $60 can be seen later this year. Well, measure it from a $26 low. That's a heck of a % move. Do that to, umpteen commodities, and you're going to have some inflation numbers.
Right.
More than the central banks want. That could rattle the bond markets, which in turn could then drag the S&P down. One of the factors you just mentioned, though, is the dollar. And the dollar index has been sliding since last year's high, just above 100. The lows last year were generally in the 93.5, 94 zone. We've since broken below that. And annual momentum suggested that would probably happen this year, but the key factor in that's the euro. And the yen had a heck of an up move since late last year. But the euro did not. The euro basically held in a range. Well, a week or two ago, we put out a report and argued the euro had broken out. That's when it was in the high 114s. It's been up into the 116 cents, and I think we could go well above 120. That will move the dollar down because that's 57% of the dollar index. That will get your foreign exchange market factor in play.
And certainly would be bullish, I would think, for commodities and hence the inflation scare. With trillions of dollars created out of nothing, Michael, stocks are dead men walking. A dead man walking, I think, is the way you put it. With all of this money floating around, though, there are going to be people that argue that stocks can't go down. They've got to go up because you got all this liquidity in there. And certainly it seems the powers that be, the last thing they want is a crashing equity market or even a slowly declining equity market.
Well, that may be the last thing they want, but my work suggests they're going to get it. They're going to get a major dig down in the S&P. And I strongly suspect now that the first real potential resting point for the S&P for a major rally, not the one we just saw, which is only like a 12, 13, 14%, is in the high 1500s. So I've lowered my initial target. But I think that'll happen. Now, whether the bonds cause that to happen, which I suspect may be the factor. For example, the 30-year T-bond futures last week traded just below 161. I'm arguing down around 159. They're over with. They came within a point or two of numbers that they cannot visit. If they visit those numbers, they're going down. And I actually have been arguing that if bonds go down, it could be crash-like. And I'm talking the government state stuff.
Oh, that's frightening.
The reason I argue that's technical. I'm not making a fundamental case that, L. Arian makes that case, that the biggest bubble out there is the debt yield bubble. And I totally agree with him on a fundamental basis. But I'm looking at the long-term technicals, and they indicate if you break, you could break hard and fast, meaning yields could rise quickly.
Well, that is not something we look forward to. I'm a gold bug. I like to see gold rising, but the last thing any of us want to see are a chaos in the markets and crash-like circumstances, because that doesn't that's not a good thing. But it is what it is, as you point out. And I must say, Michael, that if the technicals are suggesting that L-Arian is right, I think you've got to look at it very seriously then. I think people better be aware. And, of course, the logical thing would be to get the heck out of the bond market, get the heck out of treasuries, right?
Yep, at the appropriate time. It's always.
But the problem is that all these pension funds are all these institutions don't have any place to go. It seems
that's what's so scary. The bond market used to be more evenly distributed, and now it's not. It's very heavy in that the higher yielding end, meaning the longer end of the bond market, or the bunds or the JGBs, because you can't get any interest on the short term end, the short debt. So they're out on the long end. So they're very crowded. And that is scary.
Well, it's scary, but here's something I have to tell you. This really caught my attention a little before the show started here. Ken Rogoff is suggesting that third world countries should be trading in their currencies for gold. Can you imagine that?
I think it's a great idea.
I think it's a great idea. It's a great idea for everyone, I think. But if everyone tried to get out of the door at once, it'd be like what's Doug Casey say? It's like the Niagara River going through a garden hose. So, that's the problem, isn't it?
Sometimes. Nothing we can do about it.
Nothing we can do about it. Michael, I want to thank you so much for your insights. Folks, it's OliverMSA.com, OliverMSA.com. I find Michael's work to be the most important technical work that I look at. It's not necessarily for short-term traders, but if you need to have a sense of where the markets are going longer term, to have a sense of whether you should be weighted in one direction or another, I don't know of any service that's better. It's OliverMSA.com. Thank you so much for being with us again, Michael, and we'll look forward to doing it again next week.
Thank you, Jay. Bye-bye.